Hey everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Friday, December 2nd, 2022. Hope you're all having a great week and had a great Thanksgiving. No video last week, so we're back to update you on all the important happenings in the markets and the economy. Last week was a pretty quiet week in the markets, but this week is certainly making up for that as we've had a lot on the plate of the market this week. We had Fed speak, we had inflation data, we had jobs data, and of course we have individual stocks, earnings, etc. So there's a lot to talk about. Let's get right to it, bring you up to speed on everything that matters with your money. So we've had a good couple months here in the markets, right? Markets are starting to show somewhat of a pattern change, and we're going to get to that in a moment. But one of the big events for this week was Wednesday when we heard from Jay Powell of the Federal Reserve. Now, it wasn't a standard Federal Reserve press conference. He was speaking at the Brookings Institute, more of an economic speech, if you will, talking about the future path for the U.S. economy and, of course, for federal interest rates. And it was some of the things that he said in that speech that really gave stock market bulls something to hold on to. Now, when we take a step back and we look to November 10th, we had that good CPI data, right? The first sign that inflation was starting to roll over and accelerate to the downside. Markets clearly rejoiced on that. And then since then, markets have been kind of just churning in place, consolidating some of those gains, looking for the next major catalyst. And we likely got that next major catalyst this past Wednesday when Jay Powell was giving his address. And he basically nodded to the fact that the Federal Reserve understands that they have done a lot in a short period of time with interest rates and that they need to really just let things kind of simmer here and see what the impact of those rate hikes are, right? Because we know it's a lagging impact of monetary policy. They hike rates. It takes several months to filter through the economy. So he really kind of tipped his cap to the notion that the Federal Reserve is likely going to step down the interest rate increases from these 75 basis point increases that we've been seeing to likely 50 basis points in December. So that's about a 75% probability right now that the Fed's going to go 50 basis points in December. So that'll be the first step down rate hike. Naturally, the market like that because it would signal that generally the worst is behind us in terms of these Fed hikes. Now, could we get one bad inflationary report that sends the Fed back on this path of higher rate hikes? Of course, we could. But the data that we're looking at and some of the data I'm going to share with you here in a moment does not suggest that that is going to be the case. So when we look at the market for this week, and I'll just show you the impact that Fed Chair Powell had, right? Look at this move in the S&P 500 right after he basically said those words, right? We're going to slow down the pace of rate hikes, and the market was off. Now, talk about a market that got some relief out of this statement, right? And, today we had a little bit of a move lower as the jobs report came in a little stronger than expected. I've had some people reach out to me today and say, why does a good jobs report cause the market to go down? And it's this whole notion that the economy is overheating or if it's too hot, the Fed's just going to keep hiking rates. But I don't think today's report does anything to change what we heard from Jay Powell on Wednesday. We think 50 basis points is the base case for December, and then we'll see what they decide to do in their next meeting in February. But we've noticed a really substantial pattern change in this market. Now, yes, this year has seen rallies in the market that have been met by heavy selling and failed. And we saw that over the summer and failed. But the characteristics of the most recent rally off these lows has been much different, right? So when you look at characteristics of a market, right, a bear market is generally known by large moves down and small moves up that are sold into, right? So we get these big gaps down and we get a little bounce and another big gap down and a bounce, another big gap down, right? Those bear market characteristics. Bull markets tend to be the opposite, right? So you see big moves up followed by a little consolidation, right? A little backwardation. Big moves up, a little consolidation, big moves up. Now, that is really just one of several things that we notice as a pattern change in this market. And I'll go into that a little more granularly here in a second. But nonetheless, we see the market has now recaptured its 200-day moving average for the first time in 7 months, right? So that is that overhead resistance that's really held the market down for quite some time. So to see the market move above that is certainly a good thing. But there's other things affecting the market in a positive way right now in the backdrop of this market, and we're going to cover those here today. So We told you about Powell's speech. We told you about today's jobs report came in at 263,000 new jobs added. So we're starting to see the jobs gains slow down a little bit, okay? And Powell did mention that in his speech. He said, we really want to see the labor market crack a little bit, right, before we're done with interest rates. Now, to me, that sounds so un-American that basically the Fed's saying we need people to lose their jobs before our job is done, right? That's been the Fed's way forever to fight inflation. I've never agreed with it. I never will. I don't think Americans should have to lose their job for the Fed to hit their mandate of lower inflation. But nonetheless, folks, this is what we're dealing with. So I think the signs, in the labor market slowing a little bit are something that will heed caution to the Fed. But when we look at this recent rally, okay, we're noticing a pattern change under the hood, right? So this is the same chart, just in a different program that we use here. But what you're looking at the bottom of the screen here is what we call net new highs, right? The number of stocks making new highs. And when a market is rallying, you want to see the number of stocks making new highs broadening, right? Not shrinking, broadening, right? And that tells you that leadership in the market is expanding. And if we look at this recent rally here, we basically hit a low for net new highs in the middle of the summer. And we've been seeing that steadily expand since then. And this would tell you that more and more stocks are starting to participate in this rally, which is a very good thing. We want to see broad participation across groups, right? We don't want to see 5 big stocks carrying the whole market. We want to see broad participation across all groups. And we believe that that is what we are seeing, and that's what the chart here suggests. What we also have is a scenario, let me just make this a little bigger, where we had just logged back-to-back 5% gains month over month. And if you look at the previous occurrences when this has happened, this is something that will have stock market bulls smiling, right? We look at the first month and second month returns, and then how did the S&P return in the 1, 3, 6, and 12 months thereafter. And you will see that there's an overwhelming trend here that when the market logs back-to-back 5+% gains like we just did in October and November, that there is overwhelmingly positive performance that follows that. So again, one piece of data does not make the whole story, but it's something that I think bears watching. Also, right, we like to look at things from a contrarian point of view. Investor risk appetite, right, the desire for people to own stocks is the lowest that it has been in 20 plus years, okay? This alone by itself, folks, is a screaming buy signal to buy stocks. Now, when you see something like this, register and you buy stocks. Will stocks guaranteed to be higher in a month, 3 weeks, 6 weeks? No, but it's looking out 6 to 12 months, taking a longer term view. It's times like this that we need to be selective and we need to go in, have a shopping list, and start to buy those things that have gone on sale. Because again, in markets, things tend to work in contrarian nature. When everybody is bullish, that's when you sell it and short it. And when everybody is bearish, it is time to buy. And that is what we see here. And that is what we have seen over the last really 6 weeks, this major pattern change in this market. Now, I got my notes here. Just want to make sure I don't miss anything. We had so much to cover. Okay, so the backdrop in this market has changed dramatically, right? Number one, we're seeing when the market opens, right? We're seeing when the market opens down, it's being met by buyers, right? So people are stepping into this market and they're allocating capital. Very different than really 9 months prior to this, where every market that opened lower just faded all day, right? Just bled out all day long. And we're seeing markets that are really showing that buyers are stepping up and ultimately that they're pushing momentum higher. Another thing we're seeing is, let me move this into a different time frame. We're seeing a stunning collapse in rates, right? So if you think about 2022, late 21 and early 22, what have been the two primary headwinds for stocks, other than the Fed, of course, hiking interest rates, right? It's been a strong dollar and a rising 10-year yield, right? And the narrative goes that as yields rise, stocks go down. And as the dollar rises, stocks go down. So we have seen just extreme strength in the earlier parts of this year, right? This is the 10-year yield, right? And the dollar, no different, right? Look what the dollar was really running. Let me take this out to 1 year. The dollar was running up all year. Well, now we are seeing substantial topping patterns in both the dollar and the 10-year yield. Now, I won't bore you with technical chart patterns, but basically this is what we call a head and shoulders topping pattern. And this blue line represents the neckline, right? So if you kind of just envision this with me here, you got the left shoulder, we have the head, and we have the right shoulder. And this is a significant topping pattern in markets. Now, that's not to say yields are just going to go straight down to zero, but we think the directional move for yields from here on out is lower. I think the path of least resistance is lower, and I think the dollar is telling us the very same story. So if you look at the last 2 months, where the Dow Jones rallied basically 20% in a very uncertain time, just imagine to yourself what the NASDAQ and the tech-centric indexes can do if yields and the dollar are collapsing, as it appears to us that they are and will continue to, right? Because those are the areas that are most sensitive to yields on the way up, and those are the areas that will get the most boost from yields rolling over and the dollar rolling over. So that is a substantial pattern change in terms of what we see in the backdrop of the market. So everybody just stares at the S&P or the Dow or the NASDAQ. That's great. Got to always know what they're doing. But we got to look further. We got to look at rates. We got to look at yields. And we got to look at the dollar. And the other thing I wanted to just show you quick, Fed funds effective rate, right? So when we look at the federal funds rate, right, through history, and we've had these different iterations where we've raised rates quickly in a short period of time. Never as quick as we're doing now, but we've done this before, right? What do you notice about rates? Is anytime we go on a rate hiking cycle, first comes the pause, then comes the cut, right? And then we go on another rate hiking cycle, first comes the pause, and then comes the cut. 2015 through 18, right? Hike rates, first comes the pause, then we cut rates. So you can draw your own conclusions about what's going to happen here next. But I think we all know rates are not going higher, longer, and forever. At some point, maybe some point soon, the Fed is first going to step them down, right? Like we talked about, smaller rate hikes. Then's going to come the pause. And then at some point, probably later next year, if not early 24, but probably in our view, later next year, 23, the Fed will be cutting rates again. And we'll certainly be back to remind you about this video when the day that happens, because when you look at the speed, right, that the Fed has hiked rates in this period, it's unprecedented, folks. Unprecedented. It compares to the period before the great financial crisis, and we all know how that ended. So I don't think this Fed wants to repeat the mistakes of that Fed and go into that same, territory in terms of over tightening. So again, we see these things as very important signs that the Federal Reserve is starting to acknowledge that they've done a lot of heavy lifting. A lot of the impact of their policies are being felt through this economy. And again, the pattern change in the market is something that bears watching. So does this mean, we're waving the green flag, this is the all clear signal? Not yet. Not yet. We do see signs that are very constructive. We have been adding things and components to our portfolio. We think we're very well positioned for what's to come next in this market. And again, folks, remember, there is a bearish psychosis that's just been ingrained in this market, right? You cannot find somebody who is bullish on this market right now. And that, as a contrarian, is a very good sign. Okay, so I believe, and our view is, we're in a new phase now of the markets where these gains that we see are going to be lumpy, right? They're going to come in the kind of in the order of large moves up and then consolidation, large moves up and consolidation. And there's certainly going to be back testing, and there's certainly going to be attempts by the market, right, to throw people out or shake the tree, if you will. But remember, folks, you only shake the tree, right? They only shake the tree when there's something really good at the top. And that's what we see it here. So the market is not our friend. The market always wants to create the maximum amount of pain for all investors at all times. And right now, the pain trade for this market, with so many people betting on a crash, short this market, the pain trade will be higher, and we intend to participate with that every step of the way. Just a quick note on some inflationary data, right? Because all we're talking about here is inflation, the CPI, and how that's driving the Fed. And let's take a look here. The stickiest component of inflation in the U.S. over the last 18 months has been shelter, right? Particularly rents. and we look at the month-over-month change in the national rent index, we're really starting to get somewhere in terms of rents coming down and coming down precipitously. So 3 months in a row, very important trend that's taking shape here. And if this is a leading indicator for the CPI is going to follow this lower. And also, let's just bring this chart up as well. Supply chains, right? Nobody cared about supply chains until COVID happened, and that's all we heard about and all we talked about. And supply chains and the issues in the supply chain were one of the leading causes to skyrocketing inflation, right? So what you have here is a chart showing the New York Fed Global Supply Chain Pressure Index overlaid on CPI, right? The Consumer Price Index. And if you notice, they tend to follow each other very, very closely, except the CPI just lags a little bit behind. So supply chain shot up, CPI shot up, and look where supply chain pressure index is now. It is falling very, very quickly. We expect CPI to continue to follow this analog. So folks, again, it's not the all clear signal, but I think if you're looking at this market like we are with a technician hat on, looking at the fundamentals, things look very constructive right now. There's still some pockets in the market where some froth has to come out, but we think the major components of this market have gone through, the ringer, if you will. They've seen their earnings estimates come down. They've seen big declines on earnings reports. And these are all the necessary processes of cleansing a market, finishing a bear, and getting ready to start the next bull. Now, the Dow Jones, if you like labels, right? The Dow Jones technically, and we're not, just buying into this, but the media loves labels, right? The Dow Jones technically in a new bull market. It's rallied 20% off its recent low. Any market that drops 20% from its high is in a bear market. Any market that rallies 20% from its low is in a bull market. So technically, the Dow Jones is in a new bull market, but we're not ready to call it that just yet. We want to see more confirmation, but we do expect the other indexes to play catch up. So when you look at the Dow, right, the Dow has gone on to break above its August highs. Okay, the Nasdaq still below those August highs. And the S&P still below those August highs. We expect those two indexes to play catch up with the Dow to continue to move higher. Again, not in a straight line, but I think it's going to take out these August highs, and we think the market is going to arrive at higher levels in a pretty quick fashion that's going to catch a lot of investors by surprise. So we are in a very good seasonal period now, right? December tends to be the best month on average for investors, showing gains on average of 4% per December through history. So that's a very good thing for investors to see. Now, when you look at the full backdrop, and just to kind of summarize this for you, right? So we heard from Jay Powell this week. He gave a nod to slowing down the pace of interest rate hikes. We look at Treasury yields. They're in agreement with that, and they're falling very quickly. The US dollar is falling very quickly, and it's setting the backdrop for a very favorable period here for stocks. So that's our update for this week, folks. I know there's a lot going on. We're using a new platform here on the videos today, so hopefully, visually, this is something that works well, and you guys can see, all the things that we're sharing with you here today. Share us your feedback. We're always welcome to hear that. We're always, appreciate you tuning into these videos, and we want to refine them in any way, shape, or form that we can to deliver the best product possible to you. Also, just as a side note, it's the holiday season again. The Toys for Tots drive is underway here in our office. So many of you have participated in the past, and we really appreciate it. So if there's anybody that would like to participate, you can bring or send an unwrapped toy to the office. The boxes are up front in the reception, and we will be collecting toys for the next, just check the date, until December 16th. 2 weeks from today will be the pickup date. So we thank you guys for tuning in. Hope you have a great weekend, and we'll see you back next week for the Heritage Market Update.